One of the most common questions we have is, how the heck do I know when I'm financially independent, and how do I structure my income so that I'm maximizing my assets and getting the most out of my money? So I'm going to talk about some guidelines and some very specific things to do on structuring your portfolio so that you can live off of your assets for the rest of your life and beyond.
Welcome to the Market Call Show, where we discuss what's happening in the markets and the impact on your investments. Tune in every Thursday on Apple Podcast, Google Play, Spotify, or wherever you listen to podcasts.
Welcome to the Market Call Show. This is Llanes. I am the founder of Wealthnet Investments. Today we have an interesting topic and I'm really excited about diving in, so let's get going. Hello, this is Llanes. Today I'm going to be talking about how to structure your retirement portfolio. One of the most common questions we have is, how the heck do I know when I'm financially independent, and how do I structure my income so that I'm maximizing my assets and getting the most out of my money? So I'm going to talk about some guidelines and some very specific things to do on structuring your portfolio so that you can live off of your assets for the rest of your life and beyond. Let's start off talking about what a distribution strategy is. So basically, a distribution strategy is how you plan to take your income or any withdrawals to support your lifestyle. So what you're trying to answer is, which accounts am I going to take the money from, and how much and when? The first thing you need to do is establish a budget. When will you need money and how much? So this is something that is boring, but if you don't get that done, you're not going to be able to do a distribution strategy. So we start off by looking at, what are your predictable inflows of cash? What are those sources and how much you're going to get and when? Take a look at Social Security or pension and annuities, rental income and business income. Those things that you know are predictable inflows of money. But don't count any money that's coming from your investment portfolios, only from Social Security, pension annuities, rental income, business income, things like that, so that you can actually figure out what to do with your investment portfolio. So that's the first step, getting your predictable inflows of cash. And you want to know the sources, the amounts, and the timing. The next thing you need to do is take a look at your predictable essential expenses. Things like your housing, your car loans, food, utilities, those essential expenses that you have. The next step is to set aside 2 to 4 years of essential expenses in a cash reserve or short-term bonds, or a combination thereof. And the way you calculate how much you need is based on really a couple different things. First, you want to figure out the difference between your predictable and reliable income that you have and subtract out your essential expenses. Whatever that gap is, then you need 2 to 4 years in general to have a bulletproof portfolio. I recommend having 2 to 4 years of that gap set aside in this cash and short-term bond portfolio. The next thing you need to do is to fund those discretionary, nice-to-have expenses from your growth assets, things like charity, vacations, and gifts. You want to take the rest of your portfolio and you want to invest it in a total return portfolio. That is a portfolio where you're getting the best rate of return that you can for the amount of risk that you're taking, given your risk tolerance. And that should be your stocks, your bonds, any alternatives, and fixed income securities.
If you worry about your investments, need to make complex financial decisions, or pay unnecessary taxes, a lack of proper financial planning and investing may already be costing you a great deal. When you are ready to turn your peace of wealth into peace of mind, go to wealthnetinvest.com and click on the Schedule a Call button to talk to us and get a free consultation today.
So those are the basics, but I want to talk about some basic guidelines that you can supplement this with. Number one, avoid tapping into your more volatile growth assets for funding and covering regular costs. Number two, instead use a cash reserve and short-term bond portfolio to fund and cover regular costs. Number three, invest the difference in a total return portfolio where you're maximizing your return per unit of risk. Those are more growthy type assets. Next, when it's time to rebalance your portfolio, use that time as an opportunity to raise funds to supplement your normal expenses. Sell overweighted investments, and use that cash. And last, use the rule of thumb for the order of withdrawals. First, take money from your taxable accounts, then money from your tax-deferred accounts, and then money from your tax-free accounts. So that's it. These simple rules can help you structure a better portfolio that will help you use your assets more effectively. If you'd like a free analysis to take a look at how you can do this, just let us know. Go to wealthnetinvest.com and click on the button that says schedule a call, and we'll be glad to give you some advice on that.
For the latest episode of the Market Call Show, make sure to like, subscribe, and follow us on Facebook, Twitter, and YouTube. Go to marketcallshow.com for all our past episodes and sign up to get alerts for new episodes. If you enjoy the content of this episode, please leave us a 5-star review and comments. The information in this podcast is informational and general in nature and does not take into consideration the listener's personal circumstances. Therefore, it is not intended to be a substitute for specific, individualized financial, legal, or tax advice. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a final decision. WealthNet Investments is a registered investment advisor. Advisory services are only offered to clients or prospective clients where WealthNet Investments and its representatives are properly licensed or exempt from licensure.